Hello everyone, welcome to the week 9 lecture on capital market imperfections. Today we will talk about various kinds of constraints that agents in the developing economy faces with regard to activities in the capital or financial market. And broadly speaking, we can think about three such constraints that agents in the economy faces with regard to capital market frictions. These are credit constraints, savings constraints, and insurance constraints. We will primarily be talking about credit and savings constraints today, but insurance is also another domain on which there might be lack of financial instruments um, in developing countries. So, what do we mean by credit constraints? So, primarily think about firms here, but it applies to individual consumers as well. So, either firms or households basically are unable to borrow as much as they want to meet their needs. So, firms want to borrow money in order to invest in their business or to provide working capital to buy various raw materials to sort of repair machinery, etc. So and if they're unable to borrow as much as they want, that will affect their performance. They'll affect their investment decisions going forward, and therefore it will affect the future growth of the firm, and therefore if it happens across the board in the entire economy, then it will have severe consequences for the growth of the economy as well. And capital market credit constraints are an important source of friction for firms' growth in developing countries, right? So, for example, there is a paper by Raghuram Rajan and co-author which show that uh, across countries, um, sectors that need a lot of financing, from external sources, um, they tend to grow slower in countries where financial markets are not developed, right? And that sort of it's sort of a prima facie evidence that that credit constraint is important in explaining growth rate in economies, right? So if you have a underdeveloped credit market, then firms which really need the money, for whom the return on investment would be very high, would not be able to get the money, right? Because of various information problems, various issues associated with regulations, and various issues associated with how credit is made accessible by those who have the money, the financial companies, the banks, etc. So an underdeveloped credit market will therefore have an impact on growth. On the other hand, there could be constraints on savings as well. Now, what does that mean? It primarily again relates to not firms but to individual consumers or households, um, and they may lack access to financial instruments that often many of us take for granted. So, for example, access to a bank account or access to a way to park their money without fear of losing them, right? So these kinds of saving instruments are often inaccessible to vast sections of the population in developing countries, including in India. As we know, many people in our country do not have a savings account, right? Um, and this has important consequences because if people are able to save, then they'll be able to invest in various sort of important preventative, say, health investments, which can have impacts on their health, and a lot of these development outcomes which are sort of severely in the negative region for many developing countries. A lot of this can be addressed if people are able to save and can pay for these kinds of very relatively cheap investments. So buying, let's say, bed net in countries in Africa where there's a lot of incidence of malaria, right? Now, buying bed nets is not particularly expensive, but it requires very poor people to be able to save over time in order to reach their goal of purchasing bed nets. And if they do not have any kind of instruments, reliable instruments such as a bank account or even something even rudimentary, which is something we'll talk about, then they may not be able to do that. Finally, firms often face various kinds of risk, including farms in agricultural sector who face weather risks. Similarly, household faces also various kinds of risk, health risk, other kinds of risk from uh, 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 their property being damaged, etc., accident, etc. And if the insurance market is not developed, then they'll not be able to insure against these kinds of contingencies, which may again affect their ability to accumulate wealth over time in order to make the investments that will really matter for their growth. So for firms, long-term capital investment, and for consumer households, investment in education or buying say a computer which will help in getting more skilled, etc. Right? So if their savings is always getting used up in meeting contingencies because they are not able to buy health insurance, then these kinds of inefficient allocation of money will arise, which will again have growth and development consequences. So these three are the broad kinds of frictions that we face in the capital market in developing countries, and we will start with the credit market, and then we'll talk about the savings constraint. There are papers in the syllabus that I mentioned under the insurance constraints section. If you're interested in reading up more on this, you can definitely look up some of these papers. So, what the exercise we want to do today is to try and see whether it is indeed the case that a lot of firms, including firms that are relatively large in size, face credit constraints. Okay, and because it's understandable that small firms would face credit constraints, but if it is the case that even mid-sized firms in developing countries such as in India face credit constraints, then definitely it will have severe growth implications, right? Because it will be then a market-wide phenomenon uh, uh, across industries. Um, so now, as I've already mentioned, credit market frictions implies that firms would not be able to invest if they in their business if they're willing to do so, um, uh, and what does that mean is that if you are sort of constrained to borrow, then whatever that you are able to borrow and you are able to invest at that level of capital, the marginal return that you are getting is higher than the interest rate, right? So, for example, think about this sort of standard production decision by a firm. So what I'm writing down here is a profit equation. So profit equals profit in real terms equals output produced by capital. So f of k is a production function where k is the capital minus the interest rate payment. I'm not including labor here, but you can include labor. Uh, uh, um, um, this is the net profit. Now, if you are not constrained as a firm to borrow this capital, then what you will do is you will equate the marginal product of capital with the interest rate, right? So that's the first order condition. So that's the profit maximizing action. So if you want to maximize profit, the first order condition is f prime k minus r equals 0, right? So then what you get is that you will equate the marginal product of capital with interest rate. And suppose k equal to k star solves that equation. So basically what you have is k star is the profit maximizing level of investment that you will make if you are not constrained to borrow. However, suppose you are capital constrained, so basically suppose you require to put up a lot of wealth in order to access additional capital, and you have wealth constraint, and so that automatically implies a capital constraint. Um, so for example, say banks suppose require because banks lack information, because we do not have proper credit history institutions that provide history of credits and performance of the firm. Banks rely on collateral as a sort of way to guard against possible default, which requires the firms to own a lot of wealth to begin with in order to borrow. But for many firms who do not have this kind of wealth, they are supposed constrained. They're constrained to borrow only up to k bar. Okay, so suppose the constraint is that you can borrow only up to k bar, which is sort of below the amount of capital that you would like to invest. So then what you'll do is you'll borrow up to k bar. So then you invest k equal to k bar, and at that k bar, obviously your f prime k is bigger than r, right? Why? Because marginal, you have concave production function, which means that your marginal product of capital, which is f prime k is falling in k, right? So that's what it means to have concave production function or diminishing marginal product. You have diminishing marginal product means your marginal product is lower, higher is the value of k. Or stated otherwise, the lower is the value of k, the higher is the marginal product of capital. Meaning that if you don't invest a lot, then your marginal product will be much higher. Meaning that if you invest a little bit more, you'll get a lot of, you'll get a lot of output from that investment. So that's what it means to have too low an investment. That you still have, you can generate a lot of output per unit of investment at that level. So if you're investing below your optimum at k bar, then that means your marginal product is higher, and specifically it's higher than r, because at k equal to k star they are equal. So if you reduce the k, your marginal product will go up. Okay. So basically, so that's what means. So now think about a situation where firms are capital constrained, meaning that their marginal product of marginal product of capital is above the interest rate. Now what you need is, what we are after is some kind of an empirical test of presence of capital constraint for firms. So then what you need is, you want to see when, suppose for some reason this k bar is increased because of some government regulation, then you want to see whether firms make further investment, because of this condition, firms would like to invest more if they get higher k bar, right? So if k bar goes up, you should expect not only investment goes up for a firm, but also output goes up, right? Because you're constrained, you are initially at f of k bar, now you are getting a higher value of k bar, so your f of new k bar will be higher. Moreover, your profit goes up because you are away from the optimum, which means that if you increase capital, your profit is going to go, right? So that's these are the important tests to do. So empirically, we would like to test that when k bar goes up, meaning that because of some government regulation, the capital constraint is relaxed a bit. You want to see whether these set of events follow. Okay, and that's exactly what we're going to see in in this paper by Banerjee and Duflo. So the Banerjee and Duflo, what they do is they want to test uh, uh, in a context where there is some exogenous expansion of credit, and see if investment sales and profit increase in a firm. The firms that were constrained before, right, for whom the expansion happens. So they are able to identify such a policy change in the context of India, where they are also able to identify the set of firms which were subject to this credit expansion. Now, if these firms are not credit constrained, then this expansion will not lead to any increase in sales and output. It will just lead to changes in the substitution of different sources of credit. Right. So if your credit from one source is expanding, and if you don't face any credit constraint, then you're already at the optimum. You don't need extra credit. So what you basically do is you reduce credit from some other sources and get the avail of the expansion. So what the authors do, they use changes in the policy with regard to the targeted lending program in India. So what is the targeted lending program? Um, all banks, both public and private, are required to lend at least 40% of the net credit to certain sectors which are called the priority sectors. Okay, so basically, banks have sort of banks themselves face some kind of regulation in terms of who they can lend money to, and this is sort of a regulation which says that at least 40% of the money that you lend out to various firms should go to certain sectors which government considers important. These are agricultural processing, transport industry, and importantly, small scale industries. So basically, government wants to ensure that small firms gets enough credit for growth. Now, um, what happened is that in January 1998, the definition of small scale industry changed. So initially, firms with total investment in plant and machinery below rupees 6.5 million were included as these small scale industries. So it was based on some kind of threshold which required that the plant and machinery investment has to be less than 6.5 million for you to get this sort of priority sector lending, to be eligible for private sector lending as a firm. And in January 1998, this ceiling was introduced to 30 million rupees. So it's a substantial increase. So all the firms between 6.5 million and 30 million rupees of plant and machinery investment, they were ineligible for this priority sector lending. Now they are now part of the priority sector lending, so it's now easier to become easier to get bank loans. Okay. Now, importantly, in January 2000, they basically rolled back most of these expansions. So they were sort of basically the government sort of did a flip flop. Um, they brought back the ceiling down to 10 million, not back to the earlier limit, but to substantially closer to that limit. So now in January 2000 onwards, the firms between 10 and 30, which were sort of in some sense treated by this policy change, they become untreated again. So they were no longer subject to this great expansion. So what they want to do is what the authors want to do is check the set of firms which were small based on the earlier definition, so below 6.5 million, and they want to compare the firms between 6.5 and 30 vis-a-vis below 6.5 and see whether the credit expansion, whether following 1998, these new firms which became treated in 1998, whether their credit expands much faster than those who are below 6.5 and relative to the previous period. So they're going to do a difference in difference estimation. Okay, and they're going to see whether that results in changes in differential increase in sales and profits for these firms. And then what they're going to do is compare this 1998 to 2000 period and then post 2000 period, and see whether the firms between 10 and 30 million, whether for them the credit contracts in the post period, right, post 2000, because now they were treated in 1998 to 2000, but they became untreated, so they are no longer priority sector. So again, their access to bank credit is no longer as easy. So we should expect them credit expansion contracts. So there will no longer be expansion, there will be credit contraction, and whether there's corresponding effects on negative effects on sales and profits for those firms between 10 and 30 million. Okay, so that's the idea. Now, getting data is not so easy. So what they do is they basically approach a large public bank. And they try to get some data out of them. So basically, the data that they have is from one a large public bank, and they get data from about who the firms that they have lent to. Uh, um, during this period, 1996 and 2003, and these firms have to submit their balance sheets with the bank, because bank sort of demands that you submit your performance details, given that you are getting money from the bank. So they have access to the balance sheets, which allow them to look at also sales and profits for these firms for these periods. So this is the estimation equation. So what they're going to do the regression in two parts. They're going to run two separate regression. They also run a whole sample regression, but let's just focus on these two separate ones. So what they're going to do is they're going to use the first data from 1997 to 2000, and they're going to use these 4 years to run this regression. So for every year, they're going to look at the percentage increase in capital. Okay, so capital for firm I in year T, and firm I in year T minus 1. So if you take the difference of the logs, that gives you percentage increase. Okay, so for every year you calculate the percentage increase in capital relative to the previous year. So basically you want to see whether growth rate in capital is differential. Okay, so you have basically growth rate in capital on the dependent variable, and you have a dummy for big, meaning whether you are between 6.5 and 30 million. Okay, so these are the firms that got exposed, that were treated in the post period. So post is the period after 1998. So basically, post is Rami, that equals the years 1999 and 2000. So because the reform was passed in 1998, the 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 they took credit decisions in 1998, which affected capital investments allocation in 1999, right? So that's when they expect the effect to kick in. So they're using data from 1999 and 2000. So they're calling those 2 years as post. So 1997 and 1998 are the pre-period. So they have basically 4 years of data, 2 years pre and 2 years post. So they have a dummy for big, dummy for post, and an interaction of the two. Their coefficient of interest is gamma 1 kb. Basically, the idea is that if for the big firms in the post period, that's when you should expect the capital to expand. So the interpretation of alpha is that alpha is the difference in the growth rate between the small firms below 6.5 million and the big firms in the pre-periods, right? During the period 97-98. During this time, whether big firms are growing, their capital is growing differentially than small firm, and you would expect that might happen because big firms are systematically different than small firms. Um, Post captures whether the small firms, so beta captures whether the small firms are growing over time. So post is the growth rate in capital in the post period for small firms relative to their growth rate in the pre period. And big time post, so gamma captures whether the big firms growth rate in capital is differentially larger or smaller in the post period uh, the compared to the small ones. Okay, so that's the That's the interpretation of gamma, and that's what they want to see. They want to run the same regression for the period 1999 to 2002, right? Now 1999 and 2000 are the pre-period, because these are the period when the expansion is in place. In 2000 that gets disrupted, which will have an effect on the capital in 2001. So 2001 and 2002 is a post 2 period. Post 2 is basically is a dummy that equals 1 in the years 2001 and 2002, right? And again you want to see, and now big 2 are the firms that are between 10 and 30, not 6.5 and 30, because these are the ones that were also exposed to the expansion but no longer exposed to the expansion in the post 2 period. So you want to see whether the big 2 firms in the post 2 period are differentially affected, their growth rate. So you expect gamma 2 to be negative, okay, and gamma 1 to be positive. If firms are, if firms are rate constrained, and that's exactly what they find. So let's focus on this columns 4 onwards. So this is the dependent variable log of working capital at t minus 1. And what you get is, so for example in the post, so basically this is the post coefficient for the first panel. So first panel is this 97 to 2000, and the second panel is 99 to 2003. So what you have is in the post period, the post coefficient is not statistically significant, which basically means that over time the small firms are not experiencing any significant changes in their growth rate of the capital. So growth rate of the capital for the small firm is similar in the pre and post period. So that's what this means. It's not statistically significant, it's a relatively small number. The big capital, so the big firms are indeed growing slower. So basically what it means is, so big coefficient is negative and it is statistically significant, right? And this tells us that the big firms' capital growth is almost 6 percentage point lower in the in the pre-period than than compared to the smaller firms. So the smaller firms are growing faster than the larger firms in the pre-period. And when you come to the post, then relative to this difference, in the post period, big firms grow 9 percentage points higher. So basically they close this growth differential in for the pre-period. So in the post period, both big and small firms are basically growing at the same rate, while in the pre-period big firms are growing slower. So basically that means that now relative to the last period, big firms are growing faster compared to the small firms. So that's what this captures. This captures that big firms are growing 9.5 percentage. So big firms' capital growth is 9.5 percentage points, 9.5 percentage points greater in the post period, right? And that's statistically significant. They look at firms for whom the capital limit was changed. So basically, banks have some, banks provide some kind of a limit for each firm. Say that you can borrow every period, but your borrowing has to be below this limit. So the bank sets that limit. So now, due to this expansion, you would expect this limit to change for some of these firms, right? And what they are showing is that this effect is primarily concentrated in those firms. So for those firms for whom the bank changed the limit, for them the growth rate is even larger. So the growth rate is 27%, differently larger, 27 percentage point difference, really larger, right? So that's sort of is important. In column 6 and 7, they again do the same, but only for firms for whom they have the sales data. They want to do that because only for this sample you can check sales. You can check the effects on the sales as well. So you want to ensure that when you look at the sales, since you're looking at a different sample, you want to see whether the capital result also holds for that sample for whom you have the sales data. So as you can see, we have fewer observation in the whole sample, 924 in the whole sample, but 9718 in the whole sample with sales data. So again, what you get is that there again there is significantly higher growth rate of 8.7 percentage points. So these are sort of similar but a bit different compared to column 4. And again, if you look at for the sample for whom this limit has been changed, you see it's 26 percentage points higher, which is again similar to column 5 result. So what you get is even for the firms for whom you have the sales data, the result is similar. So then you can go ahead and look at the sales and costs and profits. Okay. So the first thing is that these during this period, these treated firms capital growth rate increased substantially in the post period, right? So that's the result. Let's look at the post 2 period. So now we are comparing the regulation credit expansion period with the post expansion period, where the credit should contract for those big firms. So these, they call these firms between 10 and 30 million the biggest firms. And again, what you see is that you get a negative coefficient. So what you get is that their capital growth rate became slower by 12 percentage points in the post 2 period, relative to the other firms. Okay, and if you restrict to the sample for whom the capital limit was changed, the growth rate is even stronger. So it's fall by 44 percentage points. That's a large contraction. Okay, so these firms were no longer a member of priority sector in the post 2 period, and we see that because of that they lose access to credit, and for them their credit, the capital allocation contracts, and same for this, for the sample for whom the sales data is available. You see similar contraction. Okay. Let's look at the sales. Let's look at this row, and then we'll see separately for the firms for whom the credit limit was changed versus not changed. So if you look at the log sales, column 1, you see that the sales increased by 7 percentage points. It's noisy because the standard error is pretty high, so it's not statistically significant. But if you now separate it out for firms for whom the credit limit was changed versus not changed, you see that the effect is pretty strong for the firms that for whom credit limit was changed. It increases by 19 percentage points. The growth rate in sales increases by 19 percentage points in the post period. For the big firms that did not go through any change in limit, there was no effect. And then if you look at cost and profit growth, you see similar. So you see substantial increase in profit cost as well, because these firms are supposedly expanding their business, so their cost of production is going to go up. So their cost also increases by 18.7 percentage points. Sorry, the cost growth increases by everything is in growth. So cost growth increases by 18.7 percentage points. And profit growth increases by 50, close to 54 percentage points. So that's an enormous increase in profit growth. Okay, and there is and this number is much larger relative to for the firms that did not experiencing change in them. For them, also profit growth was about 28 percentage points, even though it's highly noisy, it's not statistically significant, but this is a large number. But this one is even larger and is also statistically significant. Okay. If you look at the 1998 to 2001 period, so they have profit data only for 2001. Um, up to 2001. There again, what you see is that you see contraction in the post 2 period. So their sales contract by 40%, sales growth contract by 40 percentage point, and cost growth contract by 37 percentage point, and a profit growth contract by 92 percentage point, right? And for the firms that do not change any limit, these effects are very minimal. Okay, so this is sort of evidence that these firms that are pretty large in Indian standard, of, with greater than 10 million of plant and machinery, these firms indeed face credit constraint. These firms are not able to borrow as much. If due to government regulation, banks give more credit to them, they seems to expand their credit. They seems to expand their capital investment, which seems to increase their sales and profit. So obviously the firms know that if they could expand their credit, their sales and profit would grow, but somehow they are not able to do so, and that's an evidence that these firms are credit constrained. If I could go back to this equation, so these firms are stuck here, so they know that if they expand beyond K bar, their profit is going to grow, right? Because they'll come closer to K star, but they are not able to do so, which is why when the credit expansion happens, their profit goes up. When again they sort of get thrown out of the priority sector tag, their credit falls, which means their profit falls again, right? So that's the idea, that's an evidence of presence of credit constraint, that somehow they are not able to meet their credit need from the market. This is trying to show which are the firms that sort of demonstrate the higher impact. So they cut the data by ownership of firms. So they look at private ownership versus partnerships or limited liability companies, and what they find is that it's the privately owned firms, right? They are able to, they are experiencing most of this effect. So their credit growth is much larger than the increase in the credit growth is much larger than the increase for the partnerships or limited liability companies. The partnerships or limited liability companies seems to have access to other forms of borrowing, say from the stock market, etc. So for them, these sort of tagging is no longer important, but for privately owned firms, it might be an important. Credit access to credit might be limited. Uh, uh, um, and similarly their sales is much higher. And if you look at the post 2 period, there again the sales is negative. Sorry, so this is B2 is the set of firms for whom there was no change in the limit. For them, the result is pretty small and statistically insignificant. So you see that most of the result is driven by privately owned firms. Um, if you look at the ratio, if you cut the data by ratio of number of employees to investment in plant and machinery, and look at the firms that have the low value of this ratio, basically for whom number of employees is not as much relative to investment, for them again the effect is much larger. So basically these firms seem to be capital constrained, who do not have a lot of whose sort of employee labor to capital ratio is relatively lower. Okay, and those the ratio is above the median, the effect is much smaller. It's only the growth in capital is only 15 percentage point greater as opposed to 65 percentage point for this. So these firms, for the below median firms, they are systematically credit constrained much more than the above median ones, and so these are the ones for whom the expansion, credit expansion has an effect. Okay, so this is basically a micro evidence that even relatively large size firms, especially the ones that are privately owned, they face these kinds of credit constraints. It's important credit constraints. So we need to think about policies that sort of try to relax these kind of credit constraints in the market. And we can on Thursday discuss potential policies that can help do so. Let's move to savings constraint. Now, as I've already argued, if think in terms of households, not firms, and households, we are thinking about why are poor households not able to save, and the consequences for not saving could be severe, because ability to save can lead investments into cheap health products such as bed nets, water connection, etc., which have very high health return. Right? You can live much longer. You will be able to earn much more and provide for family, etc. We have also seen that in the migration context, if you're able to save, you can migrate out using paying this upfront cost, and look for better opportunities. So savings can help you migrate to better opportunities as well, which can, as we saw in the case of Tanzania, has very high returns. Now, moreover, even if you don't want to invest in this kind of preventative health products, you can also meet health contingencies if you are able to save more, right? And that goes back to the insurance issue. So we are thinking about a context where insurance, health insurance is not available. So you have to meet your health contingency with sort of cash, and for that also you need savings in a world where you face insurance constraint. Okay. So savings constraint is a much more fundamental or rudimentary constraint than insurance. So in a world where savings is a constraint, if people are unable to access financial instruments to save, we think that insurance constraint is also binding, meaning that they also don't have instruments for insurance as well. So then in that context, savings becomes an even important outcome. And so this paper by Dupa and Robinson in 2013, they're asking why poor people are constrained in their ability to save, by conducting some kind of savings experiment in Kenya. So what they do is conduct experiments in rural Kenya using these savings collectives. So basically they go to one rural district in Kenya, and they work with these 113 savings collectives. These are called Roscas. Roscas are rotating savings and credit associations. So these are basically groups of individuals who meet regularly. These are like self-help groups. They meet regularly, and regularly they contribute money in a pot, which pot gets rotated around. So in every month or so, the entire pot will be made available to one member of this group. So the group would be, I'd say, let's say 10 to 12 members, and there are many such groups. So each group is a Rosca. So there are 113 Roscas in this district that they contact, and so in each Rosca, these members contribute regularly in terms of a saving in a pot, and the entire saving is made available to a member of the Rosca, who can then use the saving for whatever purpose that suits them. They can also take credit on them, and they pay repay to the pot. So this is sort of that sort of is a collective arrangement. Um, Now, what they do, what the authors do is they use these 113 rosters and randomly divide the rosters into five groups. One is a control group, and they want to do four experiments, and so each experiment is conducted on each of the four remaining four groups, right? So they have five groups. So here's the first experiment. The first experiment is called a safe box experiment. Basically, what they do is the authors give the each individual in all the rosters under experiment assigned to experiment one. Each individual gets a simple locked metal box, okay, with a padlock on it, and the key is given to the participants. So each one has the key to the box, and they just put a label on the box that it's for health deposit, um, and each participant also has a passbook to record each deposit in the box. So this is separate from the sort of regular deposits that they are making for the Rosca pot. So this is for themselves individually. So individually you can just save money. So it's like a piggy bank. That's it. Um, Experiment two is but this is sort of meant for health products. So this is not just any random piggy bank. It's a piggy bank which sort of they say is meant for purchasing health products. Okay? This kind of preventative health investments. Okay? So that's is the label on the box. The second experiment is called a lock box, where it's same as the safe experiment except that the participants are not given the key to the lock. Okay, the key is with the program officer who's sort of in charge of running these rosters. So there's a program officer who sort of monitors. So usually these rosters are associated with some microfinance institution or some bank, right? And there are these program officers who monitor the savings and credit activities of these rosters. So the key will be with the program officer. And once the individual reaches their goal of saving, which allows them to buy whatever they wanted to buy, the health product that they wanted to buy, let's say in a bed net. So use that as an example in this context. Then they are supposed to call the program officer. The program officer would then open the lock at the shop where they're going to buy and purchase the health product. Of course, there is no way for the authors to enforce this, but they report that in 74% of the cases the money was used for this health product. And when they were participating in the program, the participants believed that they could not just open the box by calling the program officer, okay, and use it for any other purpose. So this is sort of is the lockbox treatment, where the difference being that it's here you can't really take out money in the middle if you want, as opposed to here you have that flexibility here. Um, the third experiment is a health pot. So this uses the Rosca structure that is already there. So basically what they have is no longer an individual level saving, but for each Rosca they have a side pot. The pot is for the entire Rosca, where the members could contribute in addition to the regular Rosca pot. So now they have two pots. One is the whatever they had regular Rosca pot, and secondly they have this what is called a health pot, which is to be used for health purposes, and any subset of the members within a Rosca could choose to regularly contribute to this health pot. Okay, it doesn't have to be that all members of a given Rosca would have to agree for this experiment to happen. Any subset of members could do it. They could sort of on the side run this savings system, and the pot would be earmarked for a special health product, meaning that this again this the this pot will be kind of locked, and the money will be with the treasurer of that roster, and the person will accompany, the treasurer will accompany these people who are saving money in the side pot to buy the health product when the savings goal is reached, or would only open it if they say that they're going to buy it for health product, right? So it's again earmarked for the health product. Mm. Um, and in the fourth experiment, which is called a health savings account, each participant was encouraged to make regular deposits into an individual health savings account managed by the Rosca treasurer. So now this also uses the Rosca setup, but this is no longer collective. Here it is a collective. Experiment 3 is a collective pot for all the members that want to contribute, and here each participant can do it. Each participant can open a health savings account with the Rosca treasurer. Rosca treasurer will collect that money and will save it separately, or put it in a bank for those Roscas who have a bank account. And the treasurer was given a ledger book to sort of keep an account of all these deposits and withdrawals. So the funds deposited in the health savings account by each individual were earmarked for health expenditure. So basically, the idea was that you can take the money out for any health expenditure. It need not be a health product, right? It could be a health contingency. Suppose you want to pay for medication or some clinic fee. That's you can do that. All across the 4 experiment as well as in the control group, people were encouraged to save for preventative health investments. But in the control group, there was no saving instrument provided, right? So these are the experiments. So they go and do to make these sort of instruments available. Notice these are very rudimentary instruments. They are not, opening bank accounts or anything. They're giving them either an informal, either they're giving them a piggy bank, or a piggy bank without a key, or piggy bank, or a collective pot, or an individual health savings account. Okay? So these are all kind of informal savings instruments, but at least there is sort of way of ensuring that the money is kept for a specific purpose. So what are the sort of facilities that they're making available across the various treatment arms? So in the first safe box treatment, you are basically giving them a storage service, but it's not earmarked for anything. You can open the piggy bank because you have the key, and there is no social pressure on you to use it also for specific health investment. In the lockbox, you have the storage along with the earmarking. You can't take the money out beforehand, and so basically it's earmarked for this preventative health investment. And in the health pot experiment, you have both earmarking and storage, but you also have the social commitment because it's a collective pot. You're socially pressured to use it for that purpose. As compared to the health saving experiment, in the health savings account, the fourth experiment, you don't have, you have earmarking. You don't have any social commitment because it's an individual level instrument, but you have earmarking for a health in treatment as well as a health investment. It's not earmarked necessarily for a health product, okay? But it also has storage. So all treatments provide you with a storage, and 3 treatments provide you with a earmarking. This one, HSA has a separate kind of earmarking than P2 and P3, and only P3 has social commitment. So basically they want to see which one of these are important. These are regression equations. They have various kinds of treatments. So for this is sort of, it's a vector of treatments. Treatment 1, 2, 3, 4, and there is sort of B1, 2, 3, 4. These are vector of coefficients, and they want to check whether B1, 2, 3, 4 are different from 0, and they want to control for various kinds of individual level characteristics. such as age, gender, marital status. They have measured for time preference. So there's you can, as I mentioned in the last class, you can sort of run this specific survey module to get these kinds of biases. So you have time preference, etc. And your coefficient of interest is these B's. Okay. Um, what they're doing is once they provide the instrument, they go away. There are follow up at various points in time, at 6 months, at 12 months, and then later at 3 years. This I'm looking at the 12 months follow up result. So 1 year after they were given this treatment, what you basically find is that the amount spent on preventative health products since baseline is significantly higher in the safe box experiment. Even after you, in this case, you control for the individual level also, even then it's significantly higher. In the lockbox treatment, you see some positive result, but it's not, it's highly noisy. So you don't see systematic evidence that the people who have the lockbox treatment, they spend on preventative health. In the health pot treatment, it's even larger than the safe box. So it's double the size of the safe box treatment. In the health savings account experiment, you don't see any effect. So basically, what you have is that when it comes to purchasing these preventative, relatively cheap preventative health products like bed nets, it looks like the first treatment, which has storage but do not have any liquidity constraint, you don't have to lock your money in for a certain point in time, that seems to be important. So just the fact that you have a separate box which is meant to collect this money for health product, that this mental accounting along with this uh, uh, possibility that in case you need the money for emergency, you have access to it, that allows people to save basically. But locking the money in doesn't allow you to do. Basically, then you don't lock money in. So you don't put enough money there because you know that if you put money there, that's locked. You can't use it for emergencies, and that's that's why it looks like the lock box doesn't help people to accumulate enough money to save, because they don't put enough money there, right? So it looks like people like the fact that there is a storage possible with this sort of mental accounting, but they don't like the fact that that they don't that that the money will be locked. So because these are poor people who from time to time face liquidity crunch, they don't want to lock away their money. Um, it looks like social pressure helps. This one in some sense had the had the this one also had this liquidity issue. They can't take away the money right away, um, but uh, it had this added feature that other people are doing it. So this sort of helped you overcome the fact that so that you will not put away your money. So basically, what this does is that it helps you actually invest money in it because other people are doing it and you are required to do it. So social pressure sort of can get over this liquidity fear of liquidity constraint to put money in. um, and but if you use the if you use the money for in the health savings account individually, where there is no social pressure, you don't end up buying these health products. And this is because you primarily probably use it to meet health emergencies, which will show up in the next regression. So if you look at column 3 and 4 result, it asks could whether or not you were able to afford full medical treatment for an illness in the past 3 months. And it's a dummy that takes value 1 if you are not able to afford it. And what you find is that these treatments do not help you in meeting medical emergencies, medical contingencies, but this treatment does, right? If you are a member of this treatment, then you are significantly less likely to say that you are not able to afford uh, uh, um, uh, uh, medical treatment. So basically, what this account is doing, it's allowing people to save, but only to meet this kind of health emergencies, not for this kind of specific health products, preventative health products. And consistent with the first result, they were asked what kind of health goal that you want to set, basically in terms of buying to be able to buy bed net or some other water connection, etc. They're able to reach those health goals if you're a member of safe box or a health box, but not otherwise, right? So this is consistent with here, where they also spend more money if they are a member of the safe box treatment or a health box treatment. Okay. This is basically saying that they want to see whether the safe box treatment was different across people with different characteristics. And so basically what the provider is a dummy that takes value 1 if you always give out money to friends and family members who ask for your money. So basically on net your money is getting taxed because your family and friends all are in need, and they always approach you to provide the money. So you're a provider, uh, or whether in the question related to time preference, you have shown present bias. So basically you discount future much more. So basically you are present bias. So this comes from the behavioral economics literature, present biasness. If you systematically bias towards consumption in present as opposed to in future, then you are called a present bias person. So if you're present bias, you tend to save less, right? Because you discount future disproportionately more. And what they find is that people who are present bias, they tend to they don't have any effect. So basically those who are not present bias, so that's the interpretation of the safe box treatment. Now those who are neither present bias nor a provider nor married, so sorry, married is not included here. So in the OLS, this is the safe box main treatment is for the people who are neither a provider nor present bias. For them the effect is pretty strong. But if you for the present bias, you have to add these two. This is an interaction effect. So if you add these two, you basically get zero effect. So this is the total effect for the trait. So total effect for the present bias people is effectively zero. So present bias people are not able to use this storage device. So even though it allows you to do mental accounting, it only helps if you are not present bias. If you are present bias, you don't end up saving money using a piggy bank. Um, It looks like the locks box, which did not have any effect on average, it had sort of positive but insignificant effect. But for provider, it had a large effect. So for providers, it says that well, my money is locked in the box, so I can give you. So it gives them an excuse to save money basically. So basically for the set of providers, it's a useful exercise. But that sort of is specific to that context. Um, for the health pot, present biasness doesn't seem to be important. It doesn't put a negative effect on savings in the health pot, because there is social pressure to do it. So basically social pressure can overcome this sort of present biasness of individual, because they have very similar effect than the rest, compared to the rest. Providers seem to save even more. So it's for providers the effect is enormous, uh, um, and that's again because it allows them to park money away and not give it to family members. The effects are kind of similar for women as well. So if you look at the women only sample, it's, the effect is similar. So basically what you have is that present biasness seems to be an important feature that sort of affects people's ability to save money even with this sort of very simple treatment. But if you sort of add social pressure to it, being a member of this kind of savings collective can overcome this kind of present biasness. They again visit these groups after almost 3 years, after 33 months, and you see that there currently still a lot of them are using this technology. So about 40% of the people are using either the lockbox uh, uh, um, or the safe box for those who are assigned those treatment. 48% of the people who are assigned to the health pot treatment are still continuing with the health pot, and 53% of those who were assigned the health savings account were still using the health savings account. Um, right? So you see, 91% has the box. Sorry, 65%. If you look at the safe and log box, 65% still has the box, and about 83% report saving in the box for at least one specific goal. Right. So here goal means again saving for a specific health product, and reports 63% report saving in the box for at least one goal that is health related. So you see that even after 3 years, there's substantial, it is sort of changed. This one-time treatment has changed their behavior in the long run. It has sort of persistent effects on the way they are now saving money. So about 81% of people participate in the first health pot cycle, and 95% of people say that if they are participated to the first health pot cycle, they received the pot, and about 65% say that they receive the health product in kind. So they are able to actually purchase the health product using this health pot treatment. Okay. So basically, what they're showing is that even after 3 years, these treatments have had significant effects in changing their sort of long-term health behavior, savings behavior with regard to saving for a health product. And here they are showing that this actually has long-term effects on their ability to rely on these health collectives. So basically what they're showing is that those who are treated with the box treatment, the health or the safe box or a lock box, there is now significantly lower probability that those rosters are still functioning. So basically they have disintegrated, meaning that what they're implying is that these people are now have an instrument in the form of a health or a safe or a lock box, which allows them to save money to meet these kinds of specific needs. So health was just sort of one marker, but they could use this box for other purposes also, and therefore that basically reduces the need to rely on these kind of savings collectives. So basically what they're finding is that the rosters that were treated with the safe or a lockbox treatment, 3 years after, they're less likely to be still functional, right? So what they find is that they're 23 percentage point lower in the linear probability model regression, 23 to 30 percentage point lower probability that these rosters are still functioning. Basically, they're able to save on their own. Individuals find that they're able to save on their own, and therefore they no longer need to rely on these sort of savings collectives. However, these health pot and health savings account, they use the ROSCA structure as part of its treatment, and there they don't find any such fall in probability. Okay, so it looks like the ability of individuals to sort of do this mental accounting is enough for them to meet these kind of health goals by saving up. Presumably, you could have done this to meet migration costs to migrate also, and you could have done you could check whether giving this kind of specific box to help people save, do this mental accounting of saving money for a specific purpose, migration, also sort of have long-term effects on migration. So these are very inexpensive interventions, but that seems to have a long-term effect on outcome. That still begs the question why people are not doing it to begin with. It's not that lockbox are particularly expensive. They could have, they could have collectively purchased, used the money using the Rosca structure, could have purchased these boxes for individuals, and they could have done this. It's just that maybe they didn't realize how important mental accounting is to save money. And this experiment shows that ability to just mentally store money away for specific purposes goes a long way in savings. However, not for the people who are present bias. So for them, you need some social structure. So this sort of tells you, what are the sort of individual characteristics that can inhibit individual's ability to save money for specific purposes, which can have very high return, right? So these are relatively low amount of savings for in order to meet buy, bed, net, or migrate out. But we have found that people are not able to save to migrate out, or people are not able to save in absence of these small interventions like having boxes. But they are able to do it with these very sort of very little kind of experiments in the long run. So this sort of, it looks like, poor people definitely have this. They sort of underestimate the power of this mental accounting, and this sort of helps. These kind of treatments probably help them highlight or illuminate the, the importance of mental accounting for them, which changes their attitude towards saving behavior. That's why we see that this kind of long-term behavior. Let me stop here. On Thursday, we'll talk about the paper on bank expansion, bank branch expansion in India, and talk about the importance of policies in mitigating credit constraints, and about what behavioral economics has to say about uh, uh, um, ability of individuals to save more, to come out of poverty. So let me stop here.